Good afternoon, everybody. Today is Friday, the 21st of January, 2010, and the market's closed here. The S&P finished with a 29-cent gain today, and as my friend John, Apex Trader, said, it didn't feel like an up day, I think. The market was pretty much, started at pretty much its best levels for the day, and then we saw the advanced decline deteriorating here throughout the day. It closed close to its worst levels of the day, but still positive in terms of number of advancing stocks versus decliners. This week the market felt like it came in really emotionally charged with the Apple news regarding Steve Jobs' health, and then the Apple earnings on Tuesday after that. And we saw a lot of big earnings this week, as I had pointed out on earlier in the day today. It looked like Apple was looking kind of weak in this area, and I thought that, and still think it's likely to be headed at least for a test of the 50-day moving average, which is down here at about $323. So we've got a lot of emotion in this market. You look at the chart of Apple; it's not broken, but it would be definitely, I think, maybe turning a little bit more neutral here. The stock's had a hell of a rally. The last 100 points have gone pretty much uninterrupted. We came down to that 50-day moving average once, but this we are down to a bigger level, and I think we undercut maybe these highs and the reactionary low from the Tuesday's sell-off, and come down a little bit further to the 50-day moving average. Wouldn't really be a horrible thing for the stock or for the market itself. Again, the market, the S&P 500, to look at it, the definition of trend, we're in an uptrend, but there's a lot of little reasons for concern. Apple lacking follow through on the earnings, Google lacking follow through on its earnings today. The stock gapped up and pulled back hard. So 3 months ago, that last quarter, we had a big response from Google earnings. This time we gapped up a little bit and then sold off and down towards the low of the day. And maybe we get a test of the 600, that 50-day moving average in there as well. It wouldn't be a bad thing for this market. When we look at the NASDAQ itself, which I'm sure you've read this week that Apple's 20% of the NASDAQ 100. We're right on that 20-day moving average. It's we had a test of that late last year as well, and perhaps we see a little bit further profit taking down to the highs for late last year, and maybe even that rising 50-day moving average. The trend is technically still up. It's still technically higher on the daily time frame. When it comes to defining trend and that sort of thing, you have to look at it and say, what time frame are you most concerned with? And if you're looking at a daily time frame and you're an investor who's looking to stay long during corrections, then you probably ought to stay long in here, like you should have stayed long back here in November when the market had a correction above its rising 50-day moving average. As far as shorter term trends go, though, in swing trading, that sort of thing, you have to look at things like the 5-day moving average and what's the direction of that. Well, we just saw that the NASDAQ has, let's take a look at a 30-minute time frame, that the NASDAQ now, we had a little bit of support broken. That support held as resistance. We have a declining 5-day moving average, so we have a lower high and now a lower low on the 30-minute time frame. So maybe we get start making a pattern of lower highs and lower lows, and we don't want to get back involved as far as long side swing trades go until we have that alignment of trends once again. So again, when it's when you look at like I said on Wednesday, here's the definition of trend: higher highs and higher lows. And we were also looking at the financials and saying that trend is intact, and we have to look at this pullback as just a pullback, similar to these pullbacks that we've seen, this correction through time and these ones through prices since the financials broke out. Well, the financials are still in an uptrend here on the daily time frame. We have a nice pattern of higher highs and higher lows, and the financials are one of the better looking groups actually right now. If we were to take out this week's low at 1620, I think that you would want to get a lot more defensive towards the financials, though. But when you consider stocks like General Electric, which is widely considered a financial, I think, by a lot of people. General Electric up on earnings and showing big response there, and a nice looking weekly chart. Then you look at stocks like Morgan Stanley, which had a good week and day in particular today. You look at stocks like Oracle and other ones that have reported earnings. IBM up at all-time highs. Today we had seen was it ISRG had a big response to earnings. So it's not all negative. ISRG here up 12%, 35 points. So it's not all negative, but there are enough negative signs in this market that we knew this coming into earnings season, that the appetite for risk would come off a little bit, and we have to manage risk as always. It's always job number one. I will never, that's my main outlook on the market. Am I bullish or bearish? Is irrelevant. It's more how much risk is there in the market at this point? Where can we buy stocks? Where do we look for potential support at rising 20-day moving averages? We look for potential support in a stock like AIG, and then we look to the shorter term time frame to try and buy it as it rallies again. AIG never rallied again. It's a complete failure of this bigger breakout. So AIG has bigger problems. We had seen even a stock like Aruba Networks. It's been in this huge uptrend, and this doesn't look like a top to me yet. I don't know. I mean, it was a big outside down candle, but we're coming into a bigger previous level of range in here, and maybe it just needs to work off a little bit through time. If you can consider last quarter, there's the third quarter of results for 2010. A lot of people were calling the end of the market because of the stock EQIX and cloud computing and how that all blew up. Well, that stock got the crap kicked out of it and went sideways for a little bit, and it's been on a slow recovery path. And that might be the case for what we see in a stock like Cree. Cree got taken out in behind the shed and got shot. It's going to be left for dead down here to heal for a while, but perhaps it's going to recover. I don't know anything about this company fundamentally. I know they make LED lights, and that's really about all I care to know about it. FFIV got smashed hard this week as well. So we've seen some of these big momentum names. I mean, that's a tough week for FFIV. That's a tough week for Cree. That's a tough week for Coinstar. And Coinstar you might not categorize in the same caliber as Cree or FFIV, or maybe you do, or maybe you don't. I don't know. But you just look at it and say, you see big stocks like Mosaic coming in real quickly, and some of these bigger momentum names, it definitely says we have to have an extra a heightened sense of risk awareness right now. So we're still in an uptrend in most of these markets, and they just don't end very easily. If you think back to CMG, people were calling CMG a top back in here and saying it's broken and it's broken down. It's digesting some big gains in here. These stocks have these big rallies. They pull back, and yeah, you can make money on them short. But realistically, I think that CMG is kind of just correcting through time the way Netflix is. Netflix has been one that, on this day, I think a lot of people were calling a top recently. And if you've been a short seller who's taken a position against this stock with a rising 50-day moving average and these rising weekly moving averages, it's a very difficult way to make a living with trying to pick a top. Markets run up, they correct through time, and then maybe they correct through price. They undergo a stage 3 distribution before they break major support, and then we see all the moving averages declining. That's not what we're seeing in this market yet. We've got a long way to go before you can actually call this the top. Now, maybe some of you are gonna get it right and say, hey, that was the top. Congratulations if that's the game you play. But it's just not there yet, the evidence of a top. The semiconductors pulled back a little bit in here this week. They've obviously had this huge rally. As we know, they broke that little trend line, corrected through time, and then regathered their momentum. And this is a good example, I think, the semiconductors, of a group that probably sucked in a lot of short sellers in this area when that trend line broke and it looked like it was turning sideways. But with that rising 50-day moving average, just generally give it the benefit of the doubt. What does that mean? Does that mean you buy these pullbacks? Absolutely not. It means that you look for those pullbacks to settle in, then you look for low risk points to participate in that primary trend. So if we go back to AIG, for instance, you might look at it and say, well, Brian, was this innocent till proven guilty? In my mind, it was. When it broke the 20-day moving average, that was a big warning sign. And what we would have looked for is, initially we look for support along the rising 10-day moving average. The pullbacks get a little bit deeper down towards that 20-day moving average. And what we want to see them do, and what they often do, and what they will do if the trend is valid, is they'll find some support, they'll build a short-term base, and then they'll start to begin to move higher on the shorter-term time frame, back above that 5-day moving average, and they start to make that pattern of higher highs and higher lows. So we go into watch mode here. My opinion is you don't buy pullbacks. You as the stock pulls back, you watch it, and then you anticipate. That stage one short-term anticipation, you wait for price confirmation that the stock is setting back up and the buyers have regained control. Let other people do the dirty work. You don't need to go in there and average in and build your position. I mean, unless you're running $100 million, $50 million, whatever, and I don't think that's the main audience that I'm speaking to right now. So I'm talking to the people that are the main audience here, which is, let the institutions, let the people with $100 million, $1 billion, let them do the dirty work and try and find that pullback in here. We were talking about Dendrion last week, and Dendrion looked like it had the potential. We were watching this stock for a potential move above 37.50. So this was at 37.50 level. Well, in here we had that rising 5-day moving average. We were looking for it to rally, and what we would have looked for would have been something like this. We would have looked to see maybe something like that, and then that resistance becomes support, and that's why we were anticipating in here. Instead, the stock gapped lower, it recovered. Okay, maybe we're back on. Well, what we would have looked for at this point, once it got up to that declining 5-day moving average, then we would have looked for another pullback and then a higher low. So you could say, well, that would have been an inverted head and shoulders pattern if you want. But what it would have shown is that the market had encountered some resistance at 37. It just had this rally from 35.75 up to that level, pulls back, refreshes. At that point, what would have happened with this 5-day moving average would have taken a path like this. It breaks out, pulls back, and then that's where we either want to buy it here or as it begins to rally. Not on this pullback right here, but as it begins to rally, and then protect ourselves with a stop underneath that higher low. And then this would have been the ideal scenario, which is would have been to maybe have some trouble with this 39 level and then bust out next week. But obviously that was a potential scenario. That potential failed at the 200-day moving average as well, which is another piece of the puzzle. So there was no reason to buy a stock like Dendrion. Here's what the scenario that was kind of in my mind playing out in this area. This was the setup I was looking for. That's what I was anticipating. What we want to do is we want to anticipate all potential scenarios, but wait for price confirmation before we actually participate and put our money at risk, because we have to manage risk. That's the number one job that we have. So again, this week we saw a lot of stocks find that risk, or realize that there is the risk out there, and we still have another couple weeks of earnings reports still flowing out, and a little bit further pullback wouldn't be an unwelcome thing. Not in my case, in my book. The Russell 2000 has kind of led this market higher since the mid-August low, and it's broken its trend line. So I'm sure there's people short based on that. It's it's closed below that 20-day moving average 3 days ago, and a lot of people sell on that as well. Where does it have the potential to go before it's likely to find its next support? And just below, really, it's 76. Let's just take a look at that together here. We'll get the exact number. Not that it matters, but the exact number for that 50-day moving average is $76.46. I think a fool buys at $76.46 because there's no magic that says the 50-day moving average will act as support, has to act as support. But if you look at the market and you say, what's the likely scenario? The likely scenario is that it comes down towards that 50-day moving average and probably even exceeds it to the downside. Maybe we get a little flush below that 50-day moving average down towards 76, 75 and a half. And then the market begins to stabilize. But I wouldn't be a buyer at that number. To me, that's just kind of guessing. The momentum in the near term is down. I had said early this morning that the Russell was looking pretty scary because of its inability to bounce at this bigger level that has been support, and it was looking like it was building this bearish flag. Now, we didn't get a collapse down through that level. Perhaps we see a little bit more selling, like I said, next week, and down even towards 75 wouldn't be a horrible thing for this market. If you look at some simple Fibonacci, and here we can see a 38.2% retracement will get us down to 72. I think you got to be crazy to hold down to that level. But maybe we get this. Maybe this is the beginning of a deeper pullback. I don't think there's anyone I know that there's no one who knows that for sure. The only person that knows that for sure, there's a word for that person. That's a liar. Nobody knows what the market's going to do, which is why we have to anticipate all potential scenarios and then look at it and say, wait for price confirmation, and from there manage risk. Where has the market come from? How much risk is there? Am I chasing something that's already extended? Do you want to chase these semiconductors? Do you want to be the person who buys at 34.5? Who are these people? Or do you want to buy as it's starting to break some resistance? Maybe you buy up there, but as an investment, do you buy up there? It's kind of crazy. There's my mother was recently telling me how she's doing well in the market, and I hate to use her as a contrary indicator because she's my mom, but she's told me how she's been doing well in the market, and she said, I go down to the library, I get these research reports, I look at magazines, and I have a pretty good feel for it. I was like, hey, great, what am I going to say? We're in a bull market, Mom, protect yourself, have some stops, and that sort of thing. But manage risk is our number one job. We've been talking about gold and how gold, I don't think you can call it a top yet, but we've been saying it's definitely turned at least more neutral, and that if you're anything more than a longer-term investor, you want to be out of it because it looks like this support was giving way, and it did give way. Now we've got the potential for a move down towards 129 in gold, the GLD, and perhaps it even drops down to the resistance from last year near 124, and we could test the 200-day moving average. I think that though you just want to be on the sidelines waiting for the setups rather than looking at the market and saying I have to be involved in this market or that market at every given moment. That's not the way it works. That's why you want to, or that's not the way I think it should work. You want to move to where are the low risk setups, and right now there's just a lot less of them. We've seen the warning signs because those the little stocks were popping off every day, these little junk stocks, and RAS, MGP, there's just MPG, I don't even remember the symbols, but there's been a lot of little garbage stocks really just making these 10-20% moves. You see the Twitter stream getting a little bit giddy at times, and everyone starts saying, well, hey, it's the new year, I've got it right this year. But the main thing you can do to help yourself in the market is to play a very strong defense, and as the market starts pulling back, you recognize that. Hansen, we were talking about that one did break out. I didn't participate because I thought, I participated in it yesterday, then I saw I naively thought, hey, it's probably going to be pinned to 55 for options. But Hansen still looks good, maybe up towards that $60 level. But again, you have to check when are the earnings due for these plays as well. And yesterday a little junk stock, RPRX. This is one that we got involved in the chat room right here at 282, and today it failed. I mean, it's a piece of garbage. You got to leave it. You got to, it's fun grabbing these things as they make this run, but being the guy that holds it or is late to the party is the fool's game. We had one today as well, which was this USAT. We got involved in there at what was it, $1.62, right in this area here. And I mean, it makes a nice pop up to 180, 80 plus. Those are nice little moves. While you have other stocks like NTES that had a good day as well. Stock that we've had an eye on. So you want to have a diverse group of stocks to look at and recognize the environment we're in, which is we have a market that is still in an uptrend. That uptrend hasn't had a significant correction in a while, so that puts everyone on edge a little bit. Last correction, deeper correction, was back in November. It caught perfectly at that 50-day moving average. And we've seen a lot of stocks get hit hard this week on earnings, more so than I think you can. I think you can point to this week in terms of the earnings and saying that generally they, there were more dramatic and more numerous downside breaks in this market on earnings than there were positive events. I don't even know if Oracle was an earnings report, but it was just a nice looking chart. IBM, of course. But I think that, just generally speaking, more stocks were getting hit on earnings. And that raises up that cautionary flag as well. So we are still in an uptrend. I'm not going to waver from that until we get a series of lower highs and lower lows. It doesn't mean that that you just go, just because we're in an uptrend doesn't mean you go out and just buy stuff. I mean, you have to always just manage risk. It's the broken record, I know, and I'm gonna say it till I go into the grave, probably. Let's take a look at ABX. ABX looks saber-tooth tiger. It looks broken to me. I mean, it's making lower highs and lower lows. The only thing you could say is maybe it's going to find support near this 200-day moving average. But the pattern is lower highs and lower lows with a declining 10, 20, and 50-day moving average. So it's been hit pretty good this year so far. Now it looks like it's coming into a potential level of support at the 200-day moving average in this prior area where it did find support. But that doesn't, to me, mean that there's a good reason to be a buyer of it. So I would probably say you just want to stay away from that. Let's see, what else do we have here? Thank you, Sunrise Trader. Without, we always have to remember, how's it go? None of this would matter if we didn't have our health. So after this, make sure you get out and exercise. That's what Sunrise always reminds us, and it's good advice. Let's see. Catfish or Catskill Fishing, 5-day closing numbers only benchmark for the week. Dow Joe due to IBM and GE. Okay, cool. I don't know why you need to include me on every tweet that you do, but that's cool. Thanks. Good observation. Dow Jones was up a little bit. I never look at the Dow, as you guys know, but it doesn't look like we have other stock requests, that is. So anyways, I'm going to call it a day. Hope everyone had a good week, and that next week is a good week for you as well. Enjoy the weekend, and I will talk to you again on Wednesday. Thanks.